So you're joining us here in Vienna from the OPEC International Seminar, July 2025, Charting Pathways Together, the Future of Global Energy. The seminar takes place just a week after the V8 of the OPEC Plus going ahead with a fifth month of increases. The increase have caught some flat-footed in the market, a bigger than expected increase in production, 548,000 barrels per day for the month of August. But the initial reaction to oil prices were up, and oil prices for Brent were about $70 a barrel. We're going to discuss the market reaction to these increases, why have we seen this reaction, and more about the future energy transition with the focus more on energy security in the past year or so. I'm happy to be joined here in Vienna with Simon Flowers, the Chairman and Chief Analyst at Mackenzie. Simon, good to have you with us. Let me start with the market reaction. So 548,000 barrels per day increase, that's around, 4 times the initial planned rate for the increases. Why has the market been able to absorb this added production?
It's a great question, but when we think about the volatility in the market already this year, to have almost a stable reaction or intuitively the oil price has gone the wrong way, it's gone up rather than down, it might be explained by this volatility we've seen. So we're only just over 6 months into the year, and twice the price has moved above $80 a barrel, twice it's been below $65 a barrel. I don't remember it being quite so volatile. Specifically to your question, I think that OPEC Plus has made us a calculated bet that the market can actually absorb a little bit more. That's part of why the price has held up reasonably stable. Of course, we're moving into seasonally a period of high demand with the road driving season in the US and the Northern Hemisphere and what have you. So that's probably quite a smart move. But the proof of the pudding will be in the eating, as it were, in several months' time. And I think if we're seeing a period where OPEC Plus is accelerating production into the market and intends to continue that, then I think it's going to pose some challenges for the price as we get into the winter period in Q4 and Q1, when seasonally demand is a little bit lower. And all things being equal, I think the fundamentals are quite likely to take it below $60 a barrel. I say all things being equal because the one factor we've not talked about, which is partly behind that volatility, is geopolitical tension, and that's not gone away yet. Mm-hmm. So it's difficult to call, and it's helping prop up the price perhaps a little bit higher than it might otherwise be.
I mean, yeah, but who would have imagined a few years ago that US will bomb nuclear sites in Iran and oil prices wouldn't increase past $75 mark? So what does that tell you?
So on the demand side, demand has been pretty firm. It's been growing at least 1 million barrels per day for the last few years. But we've had prices above $80 a barrel for 3 years in a row now, and it's led to a little bit more non-OPEC production. So OPEC and OPEC Plus have had to hold this 6 million barrels per day off the market. So they've lost market share. And I think their broader strategy is to say, well, we want to win back our market share. So a slightly lower price allows us to put more oil onto the market. We recapture a bit of our share, and at the same time, the lower price will, over time, start to stifle new investment.
Well, we've seen this with the JP Morgan report just a few days ago, talking about a decrease in oil and gas capex this year by 1.1%. This would be the first contraction since 2020. So maybe that lower oil price is feeding into capex.
It definitely is, and it'll feed through in 2 ways. So we're already seeing the instant reflex that you see in the US lower 48 with lower rig count there. It's been steadily falling for the last 6 to 9 months actually, but it's falling again as companies start to clip back their capital expenditure plans. Then the second thing will come through in the conventional drilling, which can take a little bit more time for decision making. But if you're an oil and gas company, even though the price might be better than one might have thought, and let's say $70 is not a bad price, you're going to say, well, the world is more uncertain than we thought when we set our budget back in December 2024. What can we trim at the edges so we keep our balance sheet in shape, keep a bit of cash flow? So our view is very similar to JP Morgan. We're going to see it down this year, and I think the big question would be, is it 1% in 27 as well, or 2026? I beg your pardon. When they start to do their plans up, it could be a lot lower because there's a lot of pre-FID projects coming forward for FID and approval by companies. Although some have continued, not all of the projects are as robust as those ones that have gone through. So I expect to see it maybe a little bit lower in 2026.
Simon, so we've touched upon, or you've mentioned just a little while ago, trade tensions, geopolitics. What other big trends do you think that the energy sector will see this year and next year as well?
Let's not go past trade tensions too quickly, because we saw last night on copper and still disgusting sounding tariff potential levels, put it that way. So it's going to slow economic growth, and that feeds through to oil demand. One of the other big thematics that's happening, and we've talked about it this morning already, is AI and data centers. Now, that is a very positive thematic that just did not exist in any scale 18 months ago. And we heard one of the panelists, it was the Saudi Aramco CEO, say expectations are for power demand to be 2 to 3% through 2030, but he reckoned it could be twice that. So power demand is going really well. And although it may not affect oil directly, it's actually very interesting for gas demand, because renewables aren't going to meet that AI data center demand. A lot of it's going to come from natural gas, and that has quite big implications for Henry Hub gas prices, for global LNG prices. So I think that those are two really interesting, and then of course the energy transition more broadly.
Yeah, so what are the current transition dynamics given the landscape that we just highlighted?
Well, it's going more slowly than perhaps anybody who's a believer in the goals of the Paris Agreement of 2015-16 would like. And there are some real positives, of course. So renewable solar and wind are going very, very strongly. The record levels of capacity build out, competitive in most markets. But as so many panelists mentioned today, it's not all about phasing out oil and gas and renewables replacing it. It's got to be many, many more things. And some of the other elements of that future electrified world are going much more slowly. So I'll give you battery storage, which is making great progress. Battery storage is going to be an absolutely key component in balancing variable solar and wind dominated power systems in the future. Batteries don't last long enough, right? So that's maybe another 5 to 10 years in getting to the 24-hour storage potential and longer that we need. And things like green hydrogen, to which some countries which are big importers of oil, gas and coal, take the North Asian economies, for example, held great store by being part of a new value chain. These things are just really expensive. You can't make money, they need subsidies, and there's the problem, that the subsidies have to be paid for by governments, or in inverted commas, the taxpayers in countries.
Is it politically viable, given really what we've been seeing recently?
I don't think it is politically viable, and Europe is doing its very best to hold the line in supporting, but individual countries there are having difficulties because their economies are growing more slowly, so their tax revenues are a bit lower than they would like. They're being called to put much more into defence and health and other factors. So the sustainability question is still out there. It's difficult to justify big subsidies. So I think it's going to slow that whole down, which brings us back to oil and gas. And we'd rather agree that oil and gas is going to be around for quite a bit longer.
So what could be the potential disruptors to the energy mix globally over the next years, you think?
Well, I think the easy one would be to say China holds the whip hand in this. So with the US coming out of the Paris Agreement, China has a great opportunity, not just geopolitically, but economically to take a lead in this. And there are two very clear examples. So they're building out twice more capacity in solar and wind than the rest of the world put together, and that's likely to continue. So they can spread that even further than they are already around the different world, exporting solar panels and what have you. And the second thing is electric vehicles, where the sales of EVs in China are exceeded only by Norway, which of course is a pretty small market, but they're 50% or just above already, and it's so much more than any other large economy. And I think one of the opportunities for the Chinese is to, if they can deliver relatively low-cost electric vehicles to the rest of the world, that's a big change. And so we go back to oil demand. The big threat to oil demand is in transport and in electric vehicles. Yeah. So I'd say it'd be super interesting to have a clear view to 2030 and see where Chinese EVs have got to by then outside China. I'm sure they'll be up at 70-75% in China by that time, but are they making really big inroads into, have they been allowed to make big inroads into the domestic markets of some other countries?
But I mean, we've heard in the past few years that 2019 was peak demand for oil. That absolutely did not materialize. Now people are talking any plateau in oil demand is not going to come before 2030. So when do you expect this plateau to happen? And more importantly, what's past that plateau? A very, small declines, flattish performance maybe?
Well, look, there's a massive range of expectations. When you take a really long-term view, a net zero outcome is below 30 million barrels per day, so that's a 70% drop from where we are today. But there are plenty of scenarios, not ours I hasten to add, which have oil demand still well above 100 million barrels per day by 2050. So the jury is really out. But the thing I would say is that the world does need to move to decarbonisation, and it's going to be very difficult with oil at that sort of level. So I think there's quite a strong incentive for innovative companies, bold companies to pick the right technologies and develop them over the next 5 or 10 years, because I think there's still going to be appetite for them. They just have to get into that position where they're scalable and competitive with the alternatives in the market. And EVs are quite close to that threshold. Just needs a little bit more work in the non-Chinese developed electric vehicle market, and some other technologies might really surprise us. Who'd have thought back in 2000 that solar would be the thing it is now? Super competitive in virtually all markets. So I think there is room for surprises.